bring in Evan Lucas over at IG, get his thoughts. Firstly, Evan, on what was just, well, volatile to say the least, US session.
Yeah, what a night it was, James. And this is sort of what I'm starting to expect to see over the next, particularly the next 14 to 21 days. And the reason for it is that there isn't a huge amount of macro news. Normally this time we get seasonality. There is, as you already alluded to, that general concern around Europe. But the reason I'm watching it quite closely is because US earnings season is quite interesting at this point in time. They are seeing slight beats, and that's quite unusual for the US sort of earnings season. Normally they get good beats or no beats at all. So I find that quite interesting. A fair weather stock, and it is very much a fair weather stock to look out, is always Walmart, and they came down their numbers, which come out I think in about 2 weeks time, and downgraded their outlook. So in aftermarket trading they were down 4.6%. So there is all of this general concern. We did see interesting sort of small manufacturing data out of the US. We saw the Empire State come out. We saw a few others, and then as you alluded to, the beige book really kicked up. But what I found very interesting was what happened in the US dollar and the Japanese yen against the S&P. That really motored from around about 4 a.m. last night our time, and that really did see that sort of recovery, and all that spells volatility. And I think that's the most interesting out of this, is that at the moment there is a real two-way force in terms of what's going on. Volatility index is at its highest level since November 2011, and back then that was when the euro crisis was really starting to ramp up. There were still issues about whether or not the US was coming out of the GFC. China crash concerns were all there. So they are starting to build on the other end. Europe last night got an absolute toweling down, mostly 2% or more. Real concern whether or not Draghi's got the ability from a political side to actually do what he needs to do, considering Germany is very much resisting any form of QE. So very interesting trading time, James.
And does it continue? Does the level of volatility, does it continue? In fact, do you think it ramps up?
I think it's going to ramp up. It's the only thing that I've got any sort of conviction at with regards to being long at the moment, and that is the VIX index. And the reason for it, as I just alluded to, is that there is so many unknowns going on at the moment. As you already talked about, we know that from the Fed position, probably the people that matter being Janet Yellen, Stanley Fischer, Bill Dudley, etc., they are still dovish. They're still talking about, the Fed funds rate not lifting until, mid at the earliest next year. But there is still, that as an overhang. You've got a tightening US dollar effect on corporate earnings over in the US. There is slight sort of suggestions that maybe, consumer confidence is going to slightly move away. So watch Amex, watch Visa, watch also MasterCard when they release their numbers over the next sort of couple of days. And all of that just to me spells one thing, and that is volatile trading and an upside to the VIX index. And that's not a bad thing. It does mean, therefore, that the market is looking to protect itself from what could possibly come. When you see a market really topping out like the US did around about 4 or 5 weeks ago, when it got through to around about 2014 points, it obviously on the actual market got to 2021. That is a chance to really take a breather, and the futures are really telling me that come December, 1850 is where the S&P will be, and so that means that you've still got downward pressure on the market. So my only conviction call at the moment I've got at the moment is the VIX will be up.
Lots of interest in what happened in equities, lots of interest, as you mentioned, particularly what happened in FX, but also US Treasuries. The 10-year yield going as low as 1.86% during that session, coming back at latter stages to about 2.15%, but just incredible moves.
That's in bond market terms, that is more than incredible. That's just unheard of in terms of that kind of rapid change in movements in yields. And that also, again, just gets back to what I just said about my conviction call in the VIX. That's a pile into safety. And that's the other thing about this, is that people are, again, getting very nervous about, and let's be honest, equities as a whole, doesn't matter what type of equity you hold, whether it's, a really safe as houses supermarket through to a bank or whatever you want to call it, they are equities, and they are classified as the highest risk on the risk curve in terms of what you've got. You move down to bonds, and then you go even further to that, to sovereign bonds, so corporate and you move down. All of that means, therefore, people are worried. People are looking at total returns, and they're being eaten away. And that's what you've got to also put into the back of your mind, is that for the last 3.5 years, the US market has not seen a correction. It has been absolutely riding a high wave, and it's now people are questioning whether or not it can continue to go that high. And that's why, when it got to 18.5 times earnings, fundamentalists were saying that, yes, this has probably gone too far. Technically, it's broken and it's looking quite horrible indeed. So maybe that's all why we're seeing downward movements in the US markets. And unfortunately, that will feed through to us here in Australia as well.
Evan, before we get to the likely trading situation for our own market, what do you make of talk in the US that maybe, just maybe, this was the capitulation?
I would probably say I need that to be confirmed a little bit more before I go to that. I mean, as I said, we are in earnings season, and earnings season historically tends to always beat analyst expectations. So there is still bulls out there. There is no doubt about it that a lot of people in the US are still quite bullish on their market. They still believe that it is really moving quite nice. So I want to see 2 weeks of this kind of capitulation before I can actually confirm that. But as I said, technically, and I remember talking with you about this yesterday, technically it has broken. So on a weekly and also on a daily chart, the S&P is through their uptrend level. It's not oversold on the RSI, so all of that suggests that there is downward movement. I just want to see us get through the earnings season, and if it does continue to fall away through the October the 31st, the end of the asset purchase program, then yeah, I confirm that this is the start of the capitulation the US has been looking for.
How does it all play out for our session today?
Well, this is the interesting thing about all this. We will be down, and I'm not going to sort of, sugarcoat it in any way or form. We'll be down. We're currently calling it down around about 1.2%. So that's back into the 51 handle, so 51.70 or thereabouts. But it's only 1.2, considering the violent moves we saw in Europe, considering looking at the Nikkei futures, they're down 2.8%. It's not that bad, and the reason for it gets back to that Forex play. In US dollar terms, we have corrected. We're down 15.5% since the high in August. So there is possible signs that there might be some support. I'm certainly not saying it's happening yet, and I'm still very nervous about the fact that volatility up, the market's likely to be down. But I think it's not going to be as violent as we have seen in this country as over the last 4 or 5 weeks. So we do have the banks going earnings and also ex-dividend in the next 2 to 3 weeks. All of that may provide a little bit of a support, but it will be a negative day, unfortunately.
We saw this financial smacked during the heavy selling on the US. How does that bode for our own banks?
Yeah, and I think that's sort of what we're also seeing played out. And, the old adage over the last 3 years, and it's not really that old, but anyway, it's always been about the yield support and the dividend yield, the fact you've got support from the really, really good earnings that banks have had. Just listening to the 4 of them, I mean, Gail Kelly's been a little bit quiet, but the other 3 have been quite prominent in talking about that bank earnings are still good, but maybe not as good as what had been expected, and they've been doing a lot of tightening the belt with regards to their capital expenditure. We've always talked about the mining stocks, but the banks have been doing it as well, and there's only so much you can do with that. And revenue may have actually been hit, and we will find out on the 30th, the 31st, and the 3rd over the next 2 weeks to actually get that from ANZ, NAB, and Westpac. So for that reason, they will still give you a good dividend, don't get me wrong, but don't expect it to expand like we've seen over the last 2 or 3 years. And I think that's also going to play into the market's expectations, and that's why our banks are going to get savaged as well.
All right, Evan, good stuff. Thanks very much.
Thanks, James.